So despite all the risks that exist out there, again, ranging from the potential that the Fed doesn't get it completely right and we don't end up in a soft landing, to any number of big geopolitical issues, and it usually, right, it's the thing that you're not thinking about, that we're not even talking about, that's the risk that then really impacts the market. So despite all of that, the markets are trading very rich. Typically what you would see in a price to earnings ratio, which is a broad measure of valuation in the market, you can think about like price per square foot for real estate. Usually you're trading around 16 and a half times, something like that. Today you trade closer to 20. So you're paying a material premium on the expectation, and that's a forward PE, that earnings are going to be good. And what's the expectation for earnings? It's low double digits, about 11.4%. So if that doesn't come to fruition, and by the way, the analyst community in 2023 going into the end of the year believe we would also have low double-digit earnings growth, only to end the year basically kind of flattish. If that same sort of reality plays out, right, the earnings in the denominator don't increase as expected, well, then markets are just going to get all the more expensive. So just the price that you're paying, the value that you're getting today, it certainly is not cheap. Another thing that concerns us about the market is how concentrated it is. And in the U.S., you've probably read a handful of companies, particularly different people have different names for it, but the Magnificent Seven make up over 30% of the index. So when you used to buy the S&P 500, you used to think, gosh, you were getting a small part of 500 companies. Well, now when you buy the S&P 500, a third of it is basically 7 companies. So it's very narrow and very concentrated. The other thing that's happening, if you look at global market cap, the U.S. is making up a greater and greater proportion of the global marketplace, only because it's gone up in price. So as things go up in price, they get valued bigger, and in a market cap weighted index, they're going to make up a bigger portion. So when you look forward, you have to say, gosh, I really believe in no small part that these 7 stocks are going to continue to rise. More on that in a second. The other thing you have to say is, gosh, the U.S. used to make up roughly 40% of global market cap. Now it's over 60. So you can just play out kind of simple thought exercises in your head. If we were to continue to advance, right? So if we were to gain another 20+% of the global market cap, we would own almost 80 to 90%. In other words, U.S. denominated, or U.S. headquartered locations would basically own 90% of the corporate marketplace. And the last time we even sort of heard anything like that was Japan's ascendance in the 1980s, and it turned out they didn't own everything either. I don't think we will. But back to this idea of this Magnificent Seven, it really is fascinating. We've seen this. This is not new. If you go back to the 60s, there was what was called the Nifty 50, 50 stocks that despite price, basically were going to continue to grow, and it didn't matter what price you paid, because over time you were going to be just fine. Well, it turned out that was not such a great idea. And it's interesting, looking back at that list of names, you have some companies that have gone on to really succeed, IBM, a Coca-Cola, but you also have companies like Eastman Kodak or Sears Roebuck or General Electric. I mean, companies that either aren't here or mere shells of their former selves. And so when you look at this Magnificent Seven, don't be surprised if, prospectively, a couple decades from now, one or more of those companies is not around. Sure, I think one or more of those companies will be incredibly successful, and probably on balance, the remaining will do okay, not great. And as an alternative, I thought this is an interesting exercise. So you can spend $12 trillion and buy those 7 companies. You could also spend the same $12 trillion and buy the next largest 42 companies. The revenue of the Magnificent Seven, so if you bought that $12 trillion, you'd have $1.7 trillion of revenue. The other 42, $4.4 trillion. So well over 2x. Profit, that Magnificent Seven is generating about 358 billion of net profit. Profit of the next 42, double that at 714. So I think people need to be very thoughtful about where they're investing and how they're investing, and don't get caught up in just the euphoria and the recent performance of what's happened lately. It's fascinating when you get companies of a size like this wrapped around, like NVIDIA, let's say, a new technology. You don't know. I mean, is it worth $1.5 trillion? You don't know. Tesla, I think, is a good recent example of this. It was valued in excess of $1 trillion, and now it's gotten cut in half. So was it right then at in excess of $1 trillion, or is it right now at half the value? I don't know, but hundreds of billions of dollars swinging in either direction is a lot of money. And so again, it just speaks to the speculative nature of these stocks. I think another thing that's interesting, people have sort of gotten so complacent and excited investing in the U.S., it's worthwhile to look overseas. And got to remember, companies are not countries, and I think that's a mistake investors make. They say, well, gosh, I'm worried about Germany, therefore I'm not going to buy a German-based company, or I'm worried about any number of things. But if you just look at it, so you say, okay, talking about Tesla as we were before, so price to earnings 70 times. You can buy Hyundai for 4 times. I'm not saying they're the same company, but is one worth, almost 20 times more? And then, take another example, Apple and Samsung. Does Samsung have the same product offering as Apple? No, but it does a lot of things incredibly well. It's half the price. So is Apple worth 2 times Samsung? I think it's a good question. Or take Amazon versus China's equivalent of Alibaba. Amazon trades at 80 times earnings, Alibaba 10. So I think it's a good time to sort of step back and reassess where you are, because markets have had 15 years, and particularly over the last several years, growth and popularity of a handful of companies. And I think what will work going forward probably isn't what has worked to get us to this point.